Good morning and welcome to this recommencement from the 24th of November 2020 of the virtual meeting of the Audit Committee of Allerdale Borough Council. My name is Lee Jardine. I'm the Democratic Services Officer, and for the purposes of this meeting, I'm also the host. I'll be assisting the committee with the use of technology to manage the process of the meeting. This meeting is currently being live streamed on YouTube and a recording will be made available afterwards. Just for the benefit of those watching, we'll go to the introductions on this meeting. So starting with the members, Councillor Bainbridge.
Councillor Mary Bainbridge present.
Councillor Campbell-Savers.
Councillor Campbell-Savers present.
Councillor King.
Councillor King present.
Councillor Kirkbride.
Councillor Adrian Kirkbride, good morning.
And Councillor Tyson.
Councillor Tyson present.
Thank you. Just a reminder from the other day, we have apologies for this meeting from Councillor Hodson and Councillor Armstrong. Now we'll move over to the officers. Catherine Nicholson.
Good morning, Catherine Nicholson, Head of Financial Services and the 151 Officer.
Sharon Sewell.
Good morning, Sharon Sewell, Head of Governance and the Monitoring Officer.
Barry Lennox. We didn't hear that, Barry, if you were doing your introduction, sorry.
I beg your pardon. Barry Lennox, Financial Service Manager and Deputy Section 151 Officer.
Thank you. Paul McKenzie.
Paul McKenzie, Assurance Risk and Audit Officer.
Thank you. And we have colleagues on the call today from Grant Thornton. Richard Anderson.
Good morning, Richard Anderson, Grant Thornton, External Audit Manager.
And Gareth Kelly.
Good morning, Gareth Kelly, Director in Grant Thornton, and I am your External Audit Engagement Lead. Thank you, Lee.
Thank you very much for everyone's introductions. So as previously explained, this is a recommencement of the meeting from Tuesday. And what I'll do now is just hand you over to the chair to go back to the agenda items that we were at. Thank you.
Okay. Okay, Lee.
Yes, Chair.
Right. All right. Good morning, everybody. I am Alan Tyson, and I'm chairing this meeting, which, as Lee has just said, is a continuation of the meeting from Tuesday. And we looked at items 5, 6, 7 on Tuesday on the agenda. Today, we're dealing with item 8, the audited statement of accounts, or item 9, the audit findings report, and then finally, the letter of representation. So that is for the accounts, of course, for 2019 and 20, and the audit. Right. Item 8, audited statement of accounts.
Thank you, Chair. I'll take this particular item. Hopefully you will have received a copy of the presentation via email in the last few days. Yes. If you haven't, hopefully Lee might be able to email a copy out or share his screen. But as in previous years, I thought it would be helpful to undertake a presentation just to talk you through what are quite a large set of accounts. Just as a reminder, as the agenda papers indicate, the whole purpose of this particular item is really to ensure that the authority meets its statutory obligations in relation to approving and signing the statement of accounts prior to their publication by the statutory deadline. For 1920, you'll be aware from previous meetings that amendments were made to the accounts and audit regulations in response to COVID-19, which mean that the statutory deadline for publishing this year's accounts has been pushed back from 31st of July to the 30th of November. Although the statutory timetable has changed, other requirements contained in the regulations haven't. Therefore, before the authority can publish its statement of accounts, those accounts must still be certified by the responsible finance officer, i.e. the Section 151 officer. They must be formally approved by members by way of a resolution, which this authority is a function of the audit committee. And following that approval, they must be signed and dated by the chair of the audit committee. In addition, it's only after those formalities have been completed that the audit can issue their audit opinion. Now, prior to approval, the accounts and audit regulations require members to consider the statement of accounts. And as I said in previous meetings, the term consider is not actually defined or expanded upon in the regulations. However, the requirement for members to consider the accounts rather than simply to approve them does give us a rather strong indication that members should actively participate in reviewing the statements prior to approving them. That said, we're not expecting members to be financial experts. However, in order to provide effective scrutiny and challenge, members will nevertheless need to have a broad understanding of the contents of the accounts, including details of any changes that were made to the accounts during the course of the audit. Must be satisfied that the accounts are consistent with other financial information they may have received and with there's a broader knowledge of the authority's activities, and be satisfied with the answers given by the Chief Financial Officer, either Section 151 officer, to any specific questions relating to the accounts. There are no hard and fast rules on what aspects of the accounts members should consider. However, there's some guidance in SIPFA's audit committee guidance, which recommends that attention is focused on 5 areas. The first of which is the narrative report. So reviewing the narrative report to ensure that it's consistent with the statements and with the financial challenges and risks that the authority has faced and it is facing, and also that it's readable and understandable by the layperson. Second, it's consider the accounting policies, their suitability, and to seek explanations for any changes made to accounting policies. To review major judgmental areas, so for example, provisions. To monitor trends and review the statements for consistency with what is known about the authority's financial performance over the course of the year. And finally, to consider any significant adjustments reported by the external auditor. So with these recommendations in mind, I'd like to use this presentation to cover 5 areas with the aim of providing members with a broad understanding of the contents of the accounts and the information. These are to provide you with an overview of the content of the narrative report, to outline the changes made to accounting policies in 1920 and highlight the major judgmental areas in applying those policies. For each of the primary statements within the single entity, i.e. the authority-only accounts, we'll take a brief look at their content and purpose and set out a series of challenge questions focusing in particular on those relating to significant year-on-year changes, and so offer some explanations for those, confirming the consistency of the reported results with other financial information presented to members. We'll also look at the purpose of the collection fund and the group accounts and address some of the key challenge questions associated with these. And finally, we'll look at the changes made to the unaudited statement of accounts since their publication in mid-August. Remember, as well as pushing back the publication date for the audited accounts, the deadline for the unaudited accounts was also pushed back this year from the 31st of May to the 31st of August. A final point, this presentation is really about assisting members' consideration of the statement accounts prior to approval. Therefore, do please take the opportunity to ask questions relating to the financial statements. But what I will suggest this year, given the circumstances we find ourselves in, it may be easier if we take questions after the presentation rather than during it.
Right, thank you.
So, looking at an overview of the statement of accounts first, then the statements of accounts essentially comprise 4 primary statements and accompanying notes. These statements need to be produced by all larger local authorities, regardless of what type of authority it is or what services it provides. So these four primary statements comprise the comprehensive income and expenditure statement, movement in reserve statement, a balance sheet, and a cash flow statement. The supporting notes, which run over 100 pages, comprise a summary of significant accounting policies and other explanatory information. This will include narrative descriptions and disaggregation of items, including the primary statements, and also information on items that are not recognised in the statements, such as contingent liabilities. In addition, statutory provisions and the Code of Practice of Local Authority Accounting require the authority to include in its statement of accounts 2 additional statements. The first of these is the collection funds, which shows the transactions in respect of council tax and business rates, and that reflects the authority's role as a billing authority. And the second is a set of group accounts, which combines the income, expenditure, balances and cash flows of the authority with those of its subsidiaries, joint ventures and associates. The group accounts themselves comprise 4 primary statements: the comprehensive income and expenditure statement, movement and reserve statement, balance sheet and cash flow statement, plus supporting notes. The statements themselves are sandwiched between the narrative report and statement of responsibilities at the front of the document and the annual governance statement and glossary at the rear of the statements.
Sorry, Barry, can I just come in a moment?
You can.
Your presentation, would you like me to share it?
I think it might be helpful if you put it on screen, yeah?
Yeah, and if you just tell me where you want me to be.
Yeah, if you want to pick up from slide 5, which is headed up local authority accounts content.
Okay, I'll do that now for you. Sorry about this.
Okay, I shall just continue.
Yep.
So the other information that is included within the statement of accounts, although we're required to publish this information, technically they don't form part of the statement of accounts. So if we move on to the narrative report, so at the very front of the statement of accounts is the narrative report, and the purpose of this is to provide information on the authority, its main objectives and strategies, and the principal risks that it faces. The narrative report must also provide a fair, balanced and understandable analysis of the authority's performance and financial position. The information in the narrative report should therefore be consistent with the information in the financial statement. The narrative report also fulfills the obligations contained within the accounts and audit regulations, which require authorities to prepare and publish a narrative statement commenting on the authority's financial performance and on its economy, efficiency and effectiveness in the use of its resources over the course of the year. In terms of content, the narrative report reflects the principles-based framework contained in the Code of Practice on Local Authority Accounting.
Yep.
Under this framework, the structure and presentation of the report is left to the discretion. Sorry?
Excuse me, the slides aren't moving on. So we're still on the slide 5, I think it is. We've not gone on to the slides for narrative report yet.
Right. Okay. I can't see it. Yeah. So if Lee scrolls down to the next slide, it's headed up narrative report.
There we are.
Yeah. We're okay now.
Thank you. Yeah.
You're welcome.
Barry, if you just tell me when to change, I'll do that for you.
Yeah. Okay.
Thank you.
Yeah. Yeah. So I want to say, well, the code itself doesn't prescribe the content of the narrative report. It doesn't set out the elements that should be taken into consideration in developing the structure and content of the report. And we've used the 8 elements referred to in the code to inform the structure and content of our narrative report. So next slide. So as well as the usual content, the narrative report this year includes an additional section, which is section 9, which covers the effect of the pandemic on the provision of council services, its operating arrangements, including how it's affected the council's workforce. We also reference how it's affected the council's strategic direction, as set out in the council plan and the supporting delivery plan. and also how it's impacted on the financial performance position of the authority, both during 1920 and into 2021. In terms of the impact on the 1920 statement of accounts, the timing of the outbreak and the subsequent implementation of lockdown measures mean that whilst there were some additional costs in 1920, particularly in relation to homelessness and rough sleepers, the main impacts on the report results for 1920 and on the financial position at the end of March relate to the receipt of the first tranche of emergency funding in March, advance payments of grants in related to 2021, which were around £2.3 million, and thirdly, the impact of market uncertainty, which was created by the pandemic, on the valuation of the council's investment property and certain categories of operational property at March 20, as well as on the authority's share of the direct and indirect property investments held by Cumbria Local Government Pension Scheme. Moving on to slide 8, and turning to accounting policies. Statutory provisions require the authority to prepare its accounts in accordance with proper practices as set out in SIPFA's IFRS-based Code of Practice on Local Authority Accounting. Compliance with the code is fundamental to demonstrating the accounts show a true and fair view. The code is updated annually, and that is done to accommodate changes in the external environment, such as changes to legislation and accounting standards, as well as for suggestions made to improve or clarify specific issues or to provide additional guidance. The code's requirements then in turn provide the framework for the authority's accounting policies. And the accounting policy effectively set out the accounting rules and practices which are followed by the authority when compiling the accounts. So note 1 to the accounts confirms that the accounts have been prepared in accordance with the requirements of the code. It also describes the accounting convention adopted and sets out the basis on which the group accounts have been prepared. A detailed narrative description of the accounting policies which apply to specific types of transaction and balances is included in section 6 of the accounts. As for changes in accounting policies, well, note 2.1 discloses information about new or amended accounting standards which have been adopted in 1920. Sets of how these have impacted on the authority's single entity and group accounts. Thankfully, given the circumstances we found ourselves in this year, there were very few changes coming into force in 1920, and none of those that did had any impact on the single entity or group accounts. You'll also note in note 2.2, I've outlined changes made to the 2018-19 comparative figures, including the cost of services section of the comprehensive income expenditure statement and the expenditure and funding analysis. I will point out they're not the result of any errors, but these reflect the changes that were made to executive members' portfolios during 1920 and the requirement for the comparatives to be presented on the same basis as those for 1920. Moving on to the next slide. So if we move on to notes 3 and 4, which were set out on pages 43 to 48 of the accounts. And these set out information relating to critical judgments made in applying accounting policies and to about assumptions made about the future and other sources of estimation uncertainty. The disclosures on critical judgments deal with those circumstances where it's been necessary to exercise an element of judgment when applying the authority's accounting policies to significant transactions and balances. And the really aim of this disclosure is essentially to provide justification for the view taken by the authority in those areas of the accounts where, quite legitimately, others might have made different judgments about the accounting treatment. So as in 2018-19, the key judgments set out in note 3 cover 3 areas. So our approach to the classification of land and buildings as investment properties, the matters which we've taken into consideration in establishing the authority's control over the Keswick Museum and Art Gallery and Helena Thompson Museum Trusts and their inclusion in the authority's group accounts. And thirdly, whether certain contracts contain embedded leases. The disclosures around estimation uncertainty deal with the fact that many of the items in this statement of account can't be measured precisely and therefore need to be based on estimates. So the aim of this note is therefore to highlight those estimates where there is a significant risk that within the next financial year, a change in assumptions which underpin the current estimate could result in a material adjustment to the carrying amount of assets and liabilities. For the most part, those uncertainties disclosed largely replicate what we disclosed in 2018-19. However, you will note a significant amount of additional commentary has been added this year, drawing attention to the uncertainties created by COVID-19 on those property valuations carried out at the 31st of March 20. Now, this includes the valuation of the Council's own investment and operational properties, as well as the Council's share of the direct and indirect property investments held by the Cumbria Local Government Pension Scheme, which in turn form part of the net pension liability reported on the authority's balance sheet. So we move on to the first of the primary statements and the comprehensive income and expenditure statement. What this does is summarise the authority's financial performance during the year, the components of that performance, and whether its operations have resulted in a surplus or deficit. It's prepared using the accounting rules set out in SIPFA's IFRS-based code of practice. And this means using an accruals basis, so the comprehensive income expenditure statement not only reflects cash transactions, but also the effects of non-contract cash transactions, such as depreciation, income due but not yet received, and amounts owed for goods and services that have been received but have not yet been paid for. What the use of the accruals basis also means is that there's the surplus or deficit reported in the comprehensive income expenditure statement doesn't include any of the statutory accounting adjustments which local authorities are required to make in order to calculate the amount of income and expenditure can be charged or credited to the general fund under statutory provisions. Now that means that the surplus or deficit reported in the comprehensive income and expenditure statement will differ from amounts reported internally for budget monitoring purposes. Structure-wise, the comprehensive income and expenditure statement consists of 5 sections. First, cost of services, which are aggregated on and presented on the basis of the executive members' portfolios. We then have got the other operating income and expenditure, which includes things like parish precepts and gains or losses on disposals of non-current assets, such as property, plant and equipment. It's usually referred to this as PPE for short, so that's not to be confused with personal protective equipment. The third section is the financing and investment income and expenditure, which includes things like interest payable, interest receivable, the income expenditure and changes in fair value on investment properties. We then got taxation and general grant income, which includes income from council tax, business rates, revenue support grant, other ring-fenced revenue grants, and all capital grants and contributions. And the fifth section is other comprehensive income and expenditure, which covers items of income and expenditure basically are not allowed to be accounted for within the surplus or deficit on the provision of services. And that'll include things like unrealised gains and losses on the revaluation of PPE and actuarial valuation of pension liabilities for accounting purposes. So the key challenge questions for members in relation to this particular statement are, first of all, has there been any significant changes year on year? And if so, what are the reasons for those changes? Is the financial performance included in the accounts consistent with budget reports? And thirdly, does the statement reflect the financial performance of the authority as you know it? So if we move on to the next slide, which on this slide, we've looked at the more significant movements year on year within the comprehensive income expenditure statement, starting with the service expenditure analysis. So looking at those movements, and particularly looking at movements over £1 million, we see within this particular section of the comprehensive income expenditure statement, there are 3 items where gross income or gross expenditure has increased or decreased by more than £1 million. So the first of these relates to the finance and legal portfolio, where we've seen an increase in expenditure of £1.6 million. And that increase is really underpinned by an increase in past service costs and curtailment costs associated with the remeasurement for accounting purposes of the net pension liability. And you'll see that costs of £1.4 million were recognised this year, compared with £131,000 last year, with the main component of this change being past service costs, which this year were £1.34 million, and they were nil last year. So of that change, about £891,000 relates to additional liabilities arising from the McLeod judgment, with the remaining £449,000 relating to additional liabilities arising from a potential extension of index-linked guaranteed minimum pension benefits to members reaching retirement age, or state retirement age, I should say, after April 21. Further information on the McLeod judgment can be found in note 31.5. The 2 other items we can really consider together, and they relate to customer services, where we see the income and expenditure change by £1.7 and £1.8 million respectively. By far and away, the largest area of expenditure within this portfolio relates to housing benefits, with the reduction in expenditure being underpinned by a £1.7 million reduction in housing benefit related expenditure, and a corresponding reduction in the housing benefit subsidy income that we receive. And this essentially reflects the ongoing reductions in rent allowance payments made by the authority as claimants migrate to universal credit. So if we move on to the next slide. So below cost of services, there are 3 year-on-year variances above £1 million. The first of these relates to finance and investment income and expenditure. The components of the year-on-year movement of around £2 million are actually set out in detail in note 9, but essentially comprise 3 items. We have the change in the fair value of investment property. So last year we had a net fair value increase of around £600,000. This year there was a net reduction of around £500,000. Further details of those changes are set out in note 20, which gives you a breakdown of those movements across the different categories of investment property. Interest receivable and similar income. Last year we had a gain, a net income of £300,000, but this year there was effectively a net charge of £264,000, giving us a year-on-year change of in excess of £500,000, in fact almost £600,000, of which the majority relates to the fair value losses relating to the authority's AIP loan notes recognised in 1920. Income expenditure relating to investment properties also saw a year-on-year reduction. In this case, it was around £360,000. The second of the items of significant variance relates to the surplus on the revaluation of non-current assets. So last year, the revaluation of PPE resulted in net revaluation gains of over £5 million. This year, that figure was £1.8 million, so a year-on-year change of 3.2 million. Around 2/3 of that change relates to the revaluations of museums, theatres and public halls, which were revalued last year, but weren't revalued again this year. So that accounts for a significant portion of the year-on-year change. The final significant variance relates to remeasurement of the pension liability, which shows a year-on-year movement of £5.4 million. So the year-on-year change from a net loss last year to a net gain this year reflects the combined impact of an £11 million year-on-year movement in the remeasurement of the liability, offset by a £5.6 million movement on the remeasurement of scheme assets, which reflects actual investment returns compared to the net interest recognised in the comprehensive income expenditure statement, but also significantly it reflects an adjustment made to the allocation of scheme assets across all employees within the local pension scheme following the full actuarial valuation which was carried out in 2019. The movement in the liability side of things really essentially reflects changes made to the financial and demographic assumptions used by the actuary to calculate the pension liability. So if you are ever having difficulty sleeping, note 31 sets out more details of the components of the remeasurements in both the current and the previous financial years. The second key question for members on the next slide in relation to the comprehensive income expenditure statement is about the consistent with the information included in the budget reports and more specifically with the revenue outturn report. And that question can be answered by looking at the expenditure and funding analysis, which is included in note 6, and a table in section 6 of the narrative report. The table at paragraph 6.1 of the narrative report shows the outturn position compared with the revised budget, while the expenditure and funding analysis shows the statutory accounting adjustments made to the outturn figures in order for us to arrive at the amounts reported in the comprehensive income expenditure statement. So the revenue outturn statement was presented to the executive on the 15th of July. It's reported net service expenditure of £13.3 million and a net deficit for the year and movement on general fund balances of £846,000. Some adjustments were made after the outturn report was presented in response to additional information received after publication of the outturn report. This brought those corresponding figures to 13.456 million and 952,000 respectively. And those are the figures that you will see in the table at paragraph 6.1 of the narrative report. So if we add in the amount of general fund balances that we use to finance capital expenditure, this brings the final outturn position for budget monitoring purposes to 13.456 million and 966,000. So the expenditure and funding analysis and the supporting notes, which can be found on pages 51 onwards, then sets out the adjustments that were made to these outturn amounts, which are prepared on what we refer to as a statutory or a funding basis in order to arrive at the amounts included in the comprehensive income expenditure statement in accordance with the code. And as you'll see from the supporting notes to the expenditure fund analysis, the majority of these adjustments relate to the application of capital accounting rules and the treatment of pension costs. So a further analysis of all the adjustments made are set out in notes 6.1a to 6.1e. Moving on to the next slide, and the next statement I want to look at is the movement in reserve statement, which summarises changes to the council reserves over the course of the year, which are analysed into usable and unusable reserves. The whole purpose of the movement in reserve statement is to show how the amounts included in the surplus or deficit on the provision of services and other comprehensive income expenditure within the comprehensive income expenditure statement have impacted on council's financial resources. So usable reserves, as the name suggests, are those which can be applied to fund expenditure or reduce taxation, and will include things like the general fund balance, earmark reserves, capital receipts reserves, and capital grants unapplied. Unusable reserves, on the other hand, are those, again, as the name suggests, which can't be used to fund services. And those will include the reserves which are used to hold unrealized gains and losses, for example, the revaluation reserve, and those reserves which are used to hold timing differences associated with the statutory accounting adjustments. And that will include the reserves such as the capital adjustment account and the pension reserve. So the reserve movements included in the movement reserve statement normally comprise 3 line items plus the subtotals. You will see there the surplus or deficit on the provision of services, which is the accounting basis and is lifted from the comprehensive income expenditure statement. Other comprehensive income expenditure, again, is reported in the comprehensive income expenditure statement. And the adjustments between the accounting basis and the funding basis under regulations. And those adjustments necessary for us to move from an accounting basis to a statutory or funding basis. Although the code itself doesn't require a separate analysis of movements on the general fund and earmark reserves, you'll see that I have included the balance on each of these as a footnote, which provided a link to the details of reserves included in the outturn report. And moving on to the next slide, and the key questions for members in relation to the movement reserve statements essentially focus on 2 themes. The first of it, which is the consistency and clarity of the audit trail between amounts appearing in the movement reserve statement and the supporting notes and other parts of the statement, such as the note summarising capital expenditure and financing, and notes summarising the movements on the capital adjustment account and other usable and unusable reserves. And secondly, the consistency with other financial information, i.e. the outturn report. So in terms of some of the specific questions that members should be thinking about is, well, do the opening balances agree or reconcile with last year's closing balances? If there have been any restatements, have they been clearly explained? Do the figures in the movement reserve statement agree with the corresponding amounts in the comprehensive income expenditure statement? Do the adjustments between reserves net out to nil? Can you trace the figures in the movement reserve statement to the relevant notes, including the summary of movements on the capital adjustment account and the capital expenditure and financing notes? Do the notes adequately explain the major movements? And do the closing balances agree with amounts included in the balance sheet? Now, I'm not going to go through each of these questions in detail, but a quick review of the statements will confirm that the answer to each of these questions is yes. And these are all questions that are looked at specifically as part of the authority's own quality assurance procedures, and will also form part of the tests carried out during the audit process. So if I then move on to the balance sheet, which shows, as at the balance sheet date, the value of the authority's assets and liabilities. It's always divided into 2 halves that should, as the name suggests, balance. So in the top half, we have the assets and the liabilities, so what we own, what we're owed, and what we owe. And in the bottom half, we have the reserves, comprising the usable and unusable reserves. So within the balance sheet, the net assets are split between non-current and current assets, and current liabilities and non-current liabilities. So by non-current assets, we're essentially meaning those assets which provide benefit to the authority for a period over more than 1 year. So that will include things like property, plant and equipment, heritage assets, investment property, and long-term investments. Current assets, on the other hand, are those assets which we expect to use or turn into cash within the next 12 months. And they include things such as cash and cash equivalents, short-term investments, debtors, and stock. Current liabilities, essentially, are those financial obligations which we expect to settle within the coming year. And then we'll cover things such as bank overdraft, short-term borrowing, and creditors. And finally, we've got the non-current liabilities. which essentially covers all those financial obligations that don't meet the criteria for recognition as a current liability. And they include things like provisions, long-term borrowing, and the defined benefit pension liability. In terms of key challenge questions in relation to the balance sheet, well, firstly, have any significant year-on changes been adequately explained? Are additions to property, plant, and equipment and other categories of non-current assets consistent with the capital programme and the capital outturn position? Are there clear references to the notes where more detailed information is available? And are reasons for provisions clearly shown? As far as the references are concerned, references to supporting notes are shown on the face of the balance sheet adjacent to each line item, while analysis of provisions is included in note 30 to the accounts. And that includes a narrative description of the nature of each of the obligations and the uncertainties surrounding the amount or timing of any related payments in connection with those provisions. So the two questions I probably want to focus on now are really the reasons for any significant year-on-year changes in balance sheets amounts, and to consider whether the additions to property, plant, and equipment and other categories of non-current assets are consistent with the capital outturn position. So moving on to the next slide, and on this slide what I've done is to pick out again, using a threshold of £1 million, so those key year-on-year movements in balance sheet amounts. The first of those is cash and cash equivalents. Within that balance, we include any bank accounts, call accounts, and money market funds, which are held for treasury management purposes. Now, the movement here is not down to any single item as such, and really to understand the components of the overall year-on-year changes, you need to look at the cash flow statement. We'll come on to that shortly. However, that said, what has certainly made a significant contribution to the year-on-year increase this year was the advance payment of the grants relating to 2021 of £2.3 million. That was all part of government's response to the pandemic. So rather than being paid in instalments over the course of 2021, these were paid up front in March as a way of easing the pressure caused by the pandemic on local authority cash flows. The next item is short-term creditors, and further details on that can be found in the accompanying note, which is referenced here at note 28. But essentially, it's largely a reflection of a reduction in the category we refer to as other creditors, which includes creditors relating to items of capital expenditure. And the movement here is really underpinned by the fact that, if you recall, that during the last financial year, by which I mean 2018-19, we replaced our refuge collection vehicles fleet. So at the end of March 19, there were significant balances relating to outstanding invoices for those acquisitions, which were paid during 1920. And that's probably accounting for a quite significant portion of the year-on-year change. Contract and other liabilities, we've also seen a £2.3 million increase. The breakdown of this is in note 29. But here, really the main reason behind that change is relating to those advance payments of grants, which actually relate to the current financial year 2021. So were disclosed as a liability at the end of March 2020. Long-term borrowing, you'll see that an increase there of around £1.8 million year on year. You'll recall at the last meeting of the committee, we presented the Treasury Management Annual Report, which amongst other things looked at the borrowing activity during the course of the last year. And that movement there effectively reflects that borrowing activity, and particularly the additional borrowing of £2.5 million of PWLB loans, which is undertaken in 2019-20, and the difference being the repayments of 320,000 which were made last year, and around 370,000 which is reported in short-term rather than long-term borrowing. And finally, look at the movement on the usual reserves, which is on the next slide. So a breakdown of usable reserves is actually included in note 16, with the key elements of the decrease being the 747,000 reduction in unearmarked general fund balances and the 219,000 decrease in earmarked reserves. It gives a total reduction of 966,000, which is the 952,000 outturn deficit, which you'll see in paragraph 6.1 of the narrative report, which you referred to earlier, and the 14,000 of general fund balances that we used to finance capital expenditure, and that was included in the capital outturn report. As far as unusable reserves are concerned, you'll see that actually the overall movement is not that significant. We're talking over 100,000 there. However, in note 17, you will note some significant movements on both the capital adjustment account and revaluation reserve, albeit they tend to cancel each other out in this instance. A breakdown of the movements on the revaluation reserve is set out in note 17.1, along with a narrative explanation of the purpose of this reserve. Now, consistent with that purpose, you'll see that the main movements on the revaluation reserve are the gains arising from the revaluation of assets this year, which was in a movement of £1.8 million. As for movements on the capital adjustment account, these are set out in note 17.2. Again, it also includes a narrative explanation of the purpose of this reserve. Now, essentially, the capital adjustment account includes a lot of those statutory accounting additions, which I mentioned previously when demonstrating the link between the revenue outturn position and the amounts that appear in the comprehensive income and expenditure statement. Now, these include entries made to reverse out items relating to capital expenditure, which are included in the comprehensive income expenditure statement, such as depreciation, which isn't a charge to the general fund, and also the statutory accounting entries associated with setting aside resources to finance capital expenditure. So the next key question concerns the consistency with the capital outturn position. So total capital expenditure reported in the capital outturn report, which was presented to executive on 15th of July, was 2.18 million. And paragraph 6.4 of the narrative report sets out details of that. A further 463,000 of capital expenditure was financed from the revenue budget, whilst 550,000 of previously capitalised expenditure was written off to revenue during 1920. That brings the total net capital expenditure after roundings to 2,090,000. So the same amount can be seen in section 6 of the narrative report in paragraph 6.4 to 6.6, and in note 21 to the account, which covers capital expenditure and financing. Moving on to the cash flow statement. Well, the one statement that isn't prepared using an accruals basis is the cash flow statement. And as the name suggests, the cash flow statement focuses on cash receipts and payments during the year and the impact of these on the balance of cash and cash equivalents included in the balance sheet. The composition of cash and cash equivalents is set out in note 26 and includes cash in hand, bank current accounts, bank overdrafts, call accounts and money market funds. Within the cash flow statement itself, you'll see that cash receipts and payments are analysed under 3 headings: operating, investing and financing activities. And notes 33 to 36 provides further details of the cash flows under each of these headings. Financing cash flows include payments to or from external providers of finance, such as the receipt and repayment of external loans, investing cash flows, essentially those connected with the acquisition and disposal of long-term assets and investments. This includes cash flows from the purchase and sale of short and long-term investments, property, plant and equipment, investment properties, and the receipt of capital grants. All other cash flows are categorised under operating activities. In terms of the key challenge questions for members in relation to the cash flow statement, then firstly are there clear references to supporting notes where more information is available? Well, yes, all items are cross-referenced to supporting notes. Secondly, does the change in cash and cash equivalents agree to the balance sheet? Yes, it does. Are movements in investment and borrowing consistent with the authority's treasury activities and with the cash movements in the cash flow statement? Yes, they are. Fourth, have significant year-on-year changes been explained? So let's have a look at the significant year-on-year changes on the next slide. So the cash flow statement itself shows that over the course of 2019-20, cash and cash equivalents increased by just over £3 million compared to a reduction last year of 920,000. And that increase comprises an inflow from operating activities of about £3 million, an outflow on investing activities of around 2.4 million, and net cash inflows from financing activities of around £2.5 million. So starting with operating activities, and we've got a year-on-year change there of around £2 million. The way in which the cash flow from operating activities is derived is by adjusting the surplus or deficits on the provision of services as it appears in the comprehensive income and expenditure statement for items that are not involving the movement of cash. And also we need to remove any cash flows associated with investing or financing activities, which is shown in their own particular categories within the cash flow statement. So that relationship between the net surplus or deficit on the provision of services and the cash flow inflow from operating activities is shown in note 34.1. And what that shows is that although the reported deficit in 1920 was around £3 million higher than last year, non-cash transactions were £4.6 million higher than last year. So these are accounting for £1.6 million of the year-on-year change, with the remainder reflecting year-on-year differences in respect of those adjustments in respect of investing and financing activities. The main components of that £4.6 million year-on-year change include £2.2 million in respect of creditors, and that includes that £2.3 million that refer to with respect to the grants that were paid in advance, and also £1.5 million in respect of pension costs, and that includes that change in the past service costs again, which I referred to earlier. Net cash inflows from investing activities increased by 189,000. So although the overall change in investing activities year on year is not significant, you'll see from note 34 that there are some significant, albeit offsetting movements in cash flows relating to the purchase of property, plant equipment, investment property, which went down by £1.6 million, proceeds from the sale of investments, which fell by over £500,000, and capital grants received, which fell by, again, between 500,000 and 600,000. Cash flows within this particular category reflect expenditure on the capital programme, as well as receipts from the sale of assets and capital grants received. And these items tend to be non-recurring in nature, and that can generally contribute to significant year-on-year movements. You'll see from note 21 that last year expenditure on PPE and investment property was around £5.6 million. And That was a figure that was boosted by somewhere in the region of £3.5 million in connection with expenditure on the new refuse collection vehicle fleet and wheel bins in advance of the rollout of the new waste contract. At the end of last year, related creditors on these items, which were actually paid in the current financial year, were around £1.7 million. So that left us with a sort of a cash outlay last year on these items of around 3.9. So this year expenditure on PPE investment property was only around 840,000. So if we add that to the £1.7 million that we paid in respect of last year's expenditure, well, that gives us a net outlay this year around £2.5 million. So this accounts for around 1.4 million of the 1.5 million year-on-year movement. The final one that we'll touch on is the financing activities, and really the net movement year-on-year here is a result of the cash flows from borrowing activities. Remember, this year in 1920 we borrowed an additional £2.5 million. No new borrowing was undertaken in 2018-19, and the difference is accounted for by the changes in the movement in cash flows associated with council tax and business rates receipts, which we collect on behalf of central government and major preceptors, which we have not yet paid over, and that has moved by around 800,000. Moving on to the next slide, which covers the collection fund. So as a billing authority, we're responsible for the collection of council tax and business rates. And as such, we have a statutory responsibility to maintain a separate collection fund. The collection fund is essentially an agency account showing the transactions of the billing authority in relation to the collection of council tax and business rates from council taxpayers, and the distribution of the amounts collected to ourselves and to the precepting bodies. So that is ourselves, the county council, and the police and crime commissioner for council tax, and ourselves, the county and central government in respect of business rates. The transactions within the collection fund, they're wholly prescribed by legislation. So we have no discretion over which items of income expenditure are accounted for within the fund and which are outside. There's no requirement for a separate collection fund balance sheet, and only a limited number of supporting notes are required in respect of the collection fund. Instead of a separate collection fund balance sheet items relating to the collection fund are accounted for by including the authority's own balance sheet, including within it its share of the council tax, business rate debtors, creditors and provision balances, and also recognise the differences between business rates and council tax collected from taxpayers on behalf of central government and other major preceptors and the amounts paid over to them. Key challenge questions are relating to the collection fund. Well, are there clear references to supporting notes? And what are the reasons for significant changes? You will see references to supporting notes on the statement itself. So on the next slide, we're looking at the collection fund movements over £1 million. And essentially, we've got 3 line items within the collection fund where we've got movements over and above this amount. The first is council tax receivable. The second, contribution to previous year's deficit. And the third is the Cumbria County Council precept, i.e. the county's share of council tax bills. Looking at the increase in council tax receivable, and essentially this reflects the combined impact of several factors which were highlighted in the council tax resolution report, which went to full council in March. So Allerdale itself increased its share of council tax by 2.98%. We had an increase in the share of council tax from the police and crime commissioner of over 10%, it was 10.29%, and the county increased their share by 3.99%. That figure also includes the parish element, which increased by an average of 7.51%. The council tax base also increased by just under 1%. So last year, average band D council tax increases were around 4.84%. So if you add that increase in council tax base, that will see us arrive at the change in the council tax receivable. The payments made from the collection fund in respect of business rates and council tax are based on estimates and are set prior to the start of each financial year. Now, this means that if the amounts of council tax or business rates for the year is actually more or less than these estimated amounts, then this will result in a surplus or deficit on the collection fund, which must be distributed or repaid in the following year. So in 2018-19, the collection fund included £1.4 million to clear the estimated deficit in respect of business rates, 1st of April 2018. At the end of 2018-19, this deficit had been cleared and a small surplus was actually recorded at the end of March 2019. So the figure for contributions to previous year's deficit in 1920 is therefore nil. The Cumbria County Council precept payment, so that represents the precept levied by the county in accordance with statutory provisions, which were paid out during the financial year. So essentially, is the county's share of council tax bills, and the year-on-year increase reflects the impact of both the increase in the council tax base and the percentage increase in council tax raised by the county council. Moving on then to the next slide, which is group accounts. What the group accounts do is to consolidate the financial statements of the authority with those of its three subsidiaries, Keswick Museum and Art Gallery, Helena Thompson Museum, and Allerdale Waste Services Limited, and its one joint venture, which is Allerdale Investment Partnership. So whilst each of these is a separate legal entity, essentially what the group accounts does is to combine the transactions, the cash flows, and the balances of each of these entities as if they were a single entity. So the key question for members in relation to the group accounts are, well, are there clear references to supporting notes? What are the key differences compared to the authority-only accounts? And have significant year-on-year changes been sufficiently explained? As far as the first of these questions is concerned, cross-references to supporting notes are included in each of the primary statements to the group accounts. These are cross-referenced either to the corresponding note in the single entity, i.e. the authority, or additional column to show the movement in group reserves, and an additional line which is entitled Adjustments between Group Accounts and the Authority-only accounts, which is to reverse out adjustments made in preparing the group accounts. And include intra-group transactions. And it's just essentially to bring the authority's balances back to the amounts presented in the authority-only figures. As far as the group balance sheet's concerned, well, the main differences between the authority-only and group accounts relate to PPE, so we got a difference of 718,000. The majority of that, which relates to the Helena Thompson Museum building. We have a difference of £1.7 million relating to heritage assets to reflect the inclusion of the collections at the Helena Thompson Museum and Keswick Museum Art Gallery, and £2.35 million to reflect the inclusion of group reserves, the majority of which relates to unusable reserves associated with revaluation gains on the Helena Thompson Museum and the museum collections. These are analysed further in note G4. The final thing I want to look at, and really is just as a precursor to the consideration of Grant Thornton's audit findings report, are the amendments that were made to the unaudited statements, either as a consequence of the audit process or as a result of action taken by the authority itself in response to information received after publication of the unaudited statements. In terms of the changes made to the unaudited accounts, there was only one non-material adjustment made to the primary statements, And this followed the receipt of an updated report from the pension scheme actuary after publication of the unaudited statements. That revised schedule included a reduction in the authority's share of pension assets of 655,000. Now, although the amount itself was not just to be material, after discussions with Grant Thornton, we decided to make adjustments to the net pension liability and pension reserve balances, which appear on the authority's balance sheet, and also in the group accounts, and to the remeasurement total appearing in the comprehensive income and expenditure statement. Corresponding changes were also made to the pension disclosure in note 31. Other than this, the only other change made following audit was the insertion of additional commentary in note 4, just to draw attention to the valuation of uncertainty arising from COVID-19 on the valuation of the local government pension schemes' direct and indirect property investment assets. Further details, obviously, on these changes were set out in the audit findings report, and this is a separate agenda item. So that report will also highlight the fact there were no unadjusted errors. So just move to the final slide, and just as a recap. So at the start of this presentation, I set out a list of 5 items that we'd look at to support members' consideration of the accounts. So in addressing these, we've looked at the content of the narrative report. I've also highlighted the changes to accounting policies as a result of new and amended accounting standards. We looked at the major judgmental areas in applying accounting policies and the areas of estimation uncertainty. For each of the primary statements, we've looked at their purpose and considered a series of key challenge questions, focusing in particular on those associated with confirming the consistency of the report results with other financial information presented to members and explaining significant year-on-year changes in the amounts reported. We've also reviewed the collection fund and the group accounts and addressed some of the key challenge questions for members in relation to both of these statements, including highlighting the differences between the authority only and the group accounts. And finally, we've looked at the amendments made to the unaudited financial statements following their publication and brought members' attention to the absence of any unadjusted errors identified during the audit process. That concludes the presentation. If members do have any questions, Catherine and myself will be happy to field those.
Chair, Councillor King wishes to speak.
Sorry, Lee, did you say something to me?
Councillor King wishes to speak, Chair.
Councillor King.
Thank you. Thanks. I've got a few questions. Can I ask them all now, or shall I wait for other members first?
Well, are there concurrent questions?
Yes, more or less, I think. They're to do with a couple on the income and expenditure and a couple on the balance sheet. That's all.
Oh, okay. Yeah.
Okay.
And
one of them, sorry, it's page where we're talking about the remeasurement of the net defined liability. There's a credit of the 2,405 on the income and expenditure. It says about that in note 31, and I can't actually find what that relates to or where it is. Could you explain that for me, please?
It's confirm which particular item you're looking at.
It was it's the income and expenditure account. Can't find it. Yeah. Oh, where is it? 2405.
Barry, it's on the income and expenditure count. On
It
the face
is,
of the income
sorry,
and expenditure
it's
count,
down the
note
bottom.
31.
Yeah, thank you, sorry.
Yeah. So, so the remeasurement figure on the comprehensive expenditure statement is, if you look on note 31.2, which has a breakdown of all the individual items, and you will see towards the bottom of that table, it refers to remeasurement of net defined benefit obligation, and it breaks it down. Now, there isn't a subtotal there, so that's possibly why you're having difficulty.
Right.
So you see there's 4 items there.
Yes.
The remeasurement column. Now, what you need to do is there's actually 4 items and also 2 columns, because there's funded liabilities and there's also unfunded liabilities. So what you need to do is add the 4 items in the funded liabilities column along with the 4 items in the unfunded liabilities column.
Thank you. You did say about bedtime reading, and that's exactly what I was doing. So sorry about that.
Good.
Now, what else was there? Again, I'm not clear that I'm sure about that. It says about deficit. Oh, sorry. Just let me check this. 5155. There we are. Sorry. Also on the income and expenditure, the deficit on the provision of services is 5155, and we've got an overall deficit of 935. Where does that go in the reserves? Where does that show?
Right. So in terms of the impact on reserves, if you look at the movement on reserves statement.
Yeah.
So you've got surplus of deficit provision of services 5155. On the second line down of the movement reserve statement, you will see that in the general fund balance column 5155.
Mm-hmm. And we're on the right page.
And then you've got other comprehensive income expenditure, which is.
Sorry, can you tell me which page that is, Barry?
Yeah, I've got a copy of the account, so it's actually page 33 of the account. I'm not sure what page number it is from the agenda item.
All right.
Page 75.
Thank you. Right. Right, okay.
Yeah, so the 2 big subtotals you're looking at are the 5155 and the 4220.
There. Looking at the wrong bit.
Okay.
Yeah, thank you very much. So, then there were a couple on the balance sheet. One of them is to do with, in the notes, it's to do with 19.1. I think it's on page 121. It's to do with the regalia, civic regalia. And I've got my Workington Town hat on now. Just want to check, is the Deputy Mayor's chain included in there? Would you know?
Well, I say it should be, without having to refer back to actually the details behind it, but it should include.
Can I explain why I'm asking?
You can, yeah.
As far as the town council is concerned, the Deputy Mayor's chain is on loan to Allerdale from Workington, and so it's actually included in our balance sheet. So I don't know if you're aware of that and whether the 2 need to liaise about that.
I wasn't aware of that particular fact, but that should just effectively relate to Allerdale's civic regalia. I imagine that would include the mayoral chain, the mace. I'm not sure what else we've got in there without going back to the detailed documentation, but those will be the main items in there.
Okay, right. Thank you. I think that'll do. Thank you.
Chair, Councillor Campbell-Savers wishes to speak.
Yeah, I was wondering if I could just ask a question about the risks and uncertainties in the register that we've got. A question about, I'm just using this as an example really, but the severe weather conditions section on there. The impact section here seems to imply that this is about what looks like coastal flooding issues. I appreciate that there's some uncertainty within here. Am I right that this is underpinned by the corporate risk register? This is an abbreviation of that, is it not?
You're absolutely right. All we've done is just take an extract of some of those higher risk items from the corporate risk register.
Chair, would it be appropriate in future, if to support the understanding of this document, that we request that the corporate risk register gets sent at the same time? It might just save me. It might have saved me a couple of the questions that we get around this. And I can't hear you, Chair. You're on mute.
Yeah. Yes, it is. Yes, fine, Councillor Campbell-Savers.
So more specifically, in that particular example, it takes the example of the impact of severe weather events on its disruption with business and the impact that it has on an NDR. A question in terms of in the past, has that been a substantial impact financially for us in these 5 major flooding events that we've had within Allerdale over the last 20 years? Is there anyone that would be able to give me some idea as to what the scale of that's been?
I think we'd need to go back to the revenues team just to establish what the implications of those events had been.
I mean, I appreciate this again is an abbreviation of what's potentially in the corporate risk register, but is there a mitigation for that? I can't read from this that it doesn't really tell me that there's a mitigation in place for that.
As far as the contents of the tables in the narrative report, we've just taken a straight lift from what is in the corporate risk register.
So there's just no mitigation for that. That's a risk that we carry in.
I don't know whether Catherine or Sharon want to add anything to that.
To be fair, Councillor, I'll need to check what's on the corporate risk register. But if you go behind the corporate risk register, is that what you're reading at the moment? Sorry.
No, I'm looking at the one that's within the narrative report.
Oh, the narrative, yeah. Well, if you go onto the corporate risk register in the detail, it lists the individual risks and it lists the mitigations against the score. So we'll need to go back to that full table.
And thank you. And just for one little extra bit of information for me, now might be the right time, but there is a reference to the Cumbria NNDR group under the business rate section within this risk register. Can someone just tell me what the Cumbria NNDR group is? Just a brief explanation. I'm puzzled by this one.
Is it the reference to the Cumbria business rates pool? Sorry, I'm just...
Yeah, well, it doesn't call it the pool. It says the continued membership of the Cumbria NNDR group. Is it just the pool, or is there more to it than that?
Sorry, are you on the narrative? Just refer me to which paragraph you're reading.
Page 50, which is the second page showing the risk impact and mitigation tables. Business rates, it's got moved to 75% retention of business rates.
Yeah.
Impact on the medium-term financial plan, potential loss of growth depending on resets, difficulty in planning for growth and retaining income.
Yeah.
And then is mitigation, it says continued membership of the Cumbria NNDR group. I'm just curious as to...
Yeah, it is. It's a subgroup of the Cumbria Chief Finance Officers group. So we meet regularly as all the CFOs and where there are implications. So when we've had issues, particularly around the flooding, and there's been issues around NNDR reliefs, etc., we meet more regularly as those groups. So it's the CFO group that'll meet us and in particular talk around the issues for NNDR.
So it's information sharing, just it helps support our capability here. It's
information sharing, and sometimes it's around policy and different reliefs. So if the things that are county-wide, we try to have some sort of consistency across the board.
Thank you. Thanks very much.
Thank you.
Any other questions? Okay, I've just got one, more or less on the risk register. I noticed that climate change isn't included in any risk so far. In fact, neither not really in adaptation or in mitigation of climate change. And there hasn't been, we did in February, we basically nominally set a net zero 2030 for the climate change target. There seems, I think very soon those targets will be changing, like next month. So perhaps in future we can consider putting something about climate change in the risk register.
I'm happy to take that back to the SMT chair.
Sorry, Catherine, I didn't catch what you said. You're happy to do that?
Apologies, Chair. I said I'm happy to take that request back to the SMT.
Yeah, okay, thanks. Thank you. Now, Janet, yes.
Sorry, I've just got one more question, if I may. It's to do with note 26, where we talk about cash and cash equivalents. Do we have a permanent overdraft? What's the purpose of that?
Yeah, I'll answer that one. No, we don't have a permanent overdraft, and really that is only it's a book balance in the sense that what we do is once we have made payments, so they could be backs payments, for example, it takes a number of days for those to clear, but we need to recognise the point we make that payment. Right. So actually, we're in credit with the bank. It's just reflects basically a timing difference. So there isn't an overdraft with the bank. It is just a
I'm with you.
entry.
Thank you. Thanks.
Any more questions? No. Okay. Catherine, could I have some guidance here, or Barry? We've got to make the recommendation to approve the statement of accounts. Should we leave this until after the next item?
Yes.
We should.
Yes.
Which is okay. So we do them both at the same time. Yeah. Okay. So then I can proceed to item 9, which is the consideration of the statement of accounts by our auditors.
Yes, thank you, Chair. I will give a high-level introduction to our audit findings report, which is in effect our ISA 260 reports. That's International Standards on Auditing 260, and this is a requirement that we report to you on a formal basis the outcomes of our audit for the 1920 accounts, which Barry is taking you through comprehensively under the last agenda item. So in terms of my overall responsibilities as your external auditor, if you go to page 3 of the audit findings report itself, you will see that over pages 3 and 4, it sort of outlines my overall responsibilities, and it's broadly broken down into three areas. The first one being on giving an opinion on your financial statements, and that is whether or not it's a true and fair view of your I&E position and the balances on your balance sheet at the year end. And secondly, my secondary responsibility is in giving a value for money conclusion on whether the council is providing value for money in its use of resources. And that's often referred to as the 3 E's, so in and around arrangements on economy, efficiency and effectiveness. And then the third area of my responsibilities are linked with the Local Audit and Accountability Act 2014, which basically affords me the options to pursue other areas under that act, such as public interest report, if you receive any objections, or if there's any unlawful items of account that we encounter during the year as well, we will intervene or interject through the use of those various statutory powers. So if we take each in turn, as I say, I'm going to give you a high level introduction to the audit findings report and the key messages, which again Barry has touched on a number of those on the accounts side, and then I'll hand across to Richard to take you through some more of the detail of the report, and then we'll open it up for questions. Is that okay to proceed on that basis, Chair?
Certainly, yeah.
Yeah, thank you, Alan. So in terms of, if we take each of the three areas that I've outlined in turn. So first of all, the financial statements, as is outlined on page 3 of the headlines. Yes, we received the accounts ahead of the revised statutory deadline. It was mid-August when we received the accounts, and we do anticipate signing off by the revised statutory deadline, which is next Monday. But that is subject to us having receipt of some additional information, the main item being around some outstanding requests we have with the councillor's valuer. So anything I say is subject to that final receipt of that audit request. So in overall terms, I'm very pleased to report that the audit on the financial statements is substantially complete, and I am proposing to issue an unqualified and unmodified opinion on your financial statements. As you will see from what Barry's presented comprehensively before under the last agenda item, you have got a comprehensive set of financial statements that have been produced to a very high standard. So we do commend the authority for that, and in particular Barry's input, supported by Catherine and the wider team as well. So it is a what we would say a solid set of statements that have been produced to a high compliance standard. So in terms of the audit report opinion itself, it's outlined in more detail in the appendix to the report. I think it's really important to highlight, and again Barry did touch on this in his agenda item, is that as a direct result of COVID-19, we have been living on unprecedented times, and it has had an impact on the valuation of property, both the property that you hold as an authority, but also, as Barry mentioned, your share of the direct property and unquoted property funds that you hold within the Cumbria local government pension scheme. So it's really important to highlight that these are two areas that the valuers and RICS guidance has highlighted that as a direct result of COVID, it has generated a material uncertainty around the valuations of property at the year end. This is a national issue, so this is where property or share of property within a pension fund are material, and in any local authorities accounts this year, we are providing an emphasis of matter in our audit report. And just to reiterate that, what we're saying is that we're emphasizing it because we see it as very important for the reader of the accounts to fully understand the basis of valuations that have taken place. And it's just to say it's not a qualification. I'm just going to reinforce that message. It is not a qualification. It is merely us emphasising and drawing the reader's attention to those disclosures that you have made in your accounts. Now, the disclosures around your own properties were made in the accounts that were submitted to audit, and obviously as a result of findings from the work that's been completed on the Cumbria local government pension scheme, that was a material sum, and your share of it is also considered material for the purposes of the accounts, and you have updated your disclosures around that uncertainty as well, around the direct and indirect property investment values in your uncertainties note. So that is all we are merely doing, is emphasising that. So again, it's just to emphasise that that is not it is an unqualified and unmodified opinion that we're given on the accounts. So it's a very pleasing position to get to on there. Alongside the financial statements work, we also do a consistency check on the narrative report and on the annual governance statement. And again, as we had covered in the audit committee in detail on Tuesday, Sharon went through the post-audit adjustments on the annual governance statement. And we are pleased to report that, as I did mention on Tuesday, that post those audit adjustments, and as you have now approved that annual governance statement, that we are happy to report in our audit report opinion that it is consistent with our knowledge of the authority. So that covers the headline messages on the financial statements. There was one adjustment of 0.6 million again on the defined benefit scheme liability, but again, I won't go over that because Barry's already covered that point under the last agenda item. So moving on now to page 4 of our audit findings report, the value for money conclusion. I am pleased to report that in an overall conclusion that we've reached as a local team, which has been supported by a national Grant Thornton consistency and moderation panel that is made up of partners, directors on our audit technical team, within the public sector services assurance team, have agreed with us that in overall terms, the council has provided proper arrangements to secure economy, efficiency and effectiveness in its use of resources. That said, as is outlined in here and in more detail in our VFM section on the file, which Richard will come back to, the council has had to deal with some major initiatives, including the waste contract and the stadium project, that have presented significant value for money challenges that the authorities had to deal with during 1920, which is important to take, especially in the context of what is an already difficult financial sustainability climate. We did consider a qualification of the VFM conclusion, but as I say, the local engagement team, supported by that national consistency panel, concluded that an unqualified VFM conclusion was appropriate. There were clearly examples during the year, and some of them may have been carried over from arrangements that were put in place in previous years that were lived out through 1920, that are indicative of ineffective economy, efficiency and effectiveness for the year. But I think the deciding factor was that the council's own arrangements picked up on these on a reasonably timely basis, and through the various scrutiny and task and finish groups, particularly around these two initiatives on waste and the stadium, that the council was able to put in place remedial action. Obviously, all of those actions weren't fully implemented by year end, but there was clear evidence that the council was dealing with them on a timely basis and putting the various weaknesses right during the year, and will obviously carry into 2021 as well. But it doesn't get away from the fact that the council has incurred irrecoverable costs estimated to be around 1.3 million since 2018, and that has had obviously a clear detrimental impact on the council's usable reserves position. So, but that said, so there's a balancing act here, because if the council hadn't taken the appropriate actions during the year, I suppose you could say that the authority could have exposed itself to even greater financial risks in the short, medium and longer term. So I think on balance, and there was a significant amount of additional work that had to go in to us to reach that overall conclusion, but we feel that it is the correct conclusion, but that we are being very clear in our audit findings report on some very key recommendations, building on those recommendations and actions that the council's already taken through those task and finished group scrutiny reviews. Because as you can appreciate, you know, it's important that the authority learns its lessons from these recent events to ensure that future arrangements limits its exposure to any unnecessary liabilities, or you know, that would impact on the council delivering effective and efficient service delivery as well. So we do make some key recommendations around that. The other area that we are making a key recommendation on value for money this year, which is applying to everyone. And again, it's sort of taken the context and the climate of the financial sustainability challenges that local government faces across the board. But if you layer on top of that the impact of COVID, it is now meaning that in terms of your arrangements around ensuring effective financial management of the authority's arrangements, it is so important that agility is now brought into that mix, right from budget preparation through to monitoring, through to reporting, through to your sustainable resource deployment of resources, right through to you as members making and the executive making informed decision making at the right time and on the right latest available information. So one of the key things that we're saying this year, and this applies everywhere, is that there are things like you know, detailed sensitivity analysis, you know, various potential outcomes and scenario planning that you're now having to fine tune within your financial management arrangements going forward. Now, I've discussed this at length with Catherine and Barry, and I think everyone's in agreement, as is everyone when I discuss this wider, that, you know, these are unprecedented times that we live in, and because of that, the financial pressures that local government's under anyway, layered on top with the issue of COVID and the various potential outcomes and financial pressures that will result from that agility is key in the current climate. So again, we've made some related recommendations to that, and I'm pleased to report on both these areas that I've talked through on value for money management have accepted our recommendations, and the report contains management's responses to those as well. So that covers value for money at a high level. On statutory duties, that third area of responsibilities, as I mentioned, I'm very pleased to report that I have not had to exercise any of my additional statutory powers or duties during the 1920 audit. So that means I've not had to draw on the Local Audit and Accountability Act 2014, which is a very good position to be in. And it also is very important because it also allows me, when we've completed our work on the financial statements, we've concluded on the value for money, that I'm also able to certify closure of the audit for 1920. So again, that is at this stage is what we're planning to do. So again, that certificate is included in draft form within our audit report opinion, which is included in the appendix. It does draw me to a couple of final points before I hand across to Richard, just to take you through a bit of the detail. COVID-19 has had a massive impact, as we're all aware, but in the context of your accounts preparation and the audit, it has been challenging, because not only have you had to produce a set of statements which have, as I said, have been produced to high standard, you've also had to respond to our audit queries, and we have had to carry out the audit 100% remotely. So this has been unprecedented, series of events, and in the context of the audit, that has meant that it has taken a significantly more time than you would have in a normal course of business in a normal year. And that's why, I do apologise to the committee for the papers coming late, but there were big issues that still needed to be resolved, even into late last week, including our final value for money conclusion as well. So that this hopefully gives the committee some context as to why we are where we are. I think to be in a position to sign off by the statutory deadline is a fantastic position to be in. I can say that we're not going to be in that position across the board, nationally, nor regionally, nor locally. So, just to give it some wider context, that it has been an extremely challenging year. As a result as well, it has taken a lot longer for us to complete the audit, and we have incurred significant additional costs as a result. I've discussed this with Catherine, and what we're proposing in terms of additional fees is in the region of £7,600, which is around 15% increase on fees. Now, again, for you as those charged with governance, it's important that you're cited on this. A couple of things around that. That represents about 15%. Across the board, that is at the very lowest end of our increases that we've encountered on costs. And we're not passing on all of the costs, by the way, to you as an authority as well. We are absorbing some of those additional costs that it's taken to complete the audit this year. So that just leaves me to say that I do want to say a massive thank you and record our appreciation and thanks to Catherine and Barry in particular, and to Sharon and others wider as well in terms of the annual governance statement, etc., for your cooperation during what has been an unprecedented times. And you've ended up in a very positive position in terms of us proposal, subject to those final bits coming in from the valuer, to be in a position to give an unqualified opinion on both your accounts and your value for money, and no actions around statutory duties. So that is a high level introduction to our findings for the year. Richard will just very quickly take you through a bit of the detail in the report, Chair, and then I'm happy to open it up for questions for Richard and I.
Right,
Richard?
thank you, Gareth. Yeah.
Thank you, Chair. Richard?
Thanks, Gareth. Yes, so I'll pick up on page 5 of our report, and I'll just pick up a few points on the detail. First one to make is that in carrying out our audit, we've used the materiality that we communicated to you via our audit plan. So for the group, that was 824,000, and for the council, 822,000. So that was the materiality threshold which informed our work. We also set a clearly trivial threshold which relates to that materiality, which is the amount that if we were to find to put on our audit, that we would report it via our audit findings report. And on this audit, it was 41,000. So that's what's informed our reporting. Moving through the report, from page 6, we outline the significant risks areas of the audit. And again, this is as was reported in our audit plan. On page 6, we reflect we did have a significant risk around the impact of COVID-19. That was quite a far-reaching risk from our perspective, both around ensuring that disclosures relating to COVID-19 were appropriate in the accounts, but also the challenges that the kind of different way we were going to be delivering the audit and the accounts were going to be produced the way that it was having to be 100% remote this year. So just the challenges around that side. We've discussed the key finding here around the material uncertainty on property, both from the authority's land and buildings perspective and the pension fund share of pension fund assets, and that's the only finding we had in relation to the impact of COVID-19 on the accounts. Other significant risk areas around the valuation of land and building, as Gareth said earlier, we're finalising our procedures in this area. There was one minor issue relating to the valuation of investment property, but this was just a disclosure point highlighting that an element of the authority's investment property is currently carried at cost, and this is only a disclosure point which impacts the disclosure note, and obviously the amount is immaterial. Regarding management override of control, this is a significant risk on all audits. So you'd see this in all audit plans and audit findings reports. And as we highlight there, our audit work has not identified any issues in respect of this risk. Moving on to page 8 of the report, the other significant risk on this audit was around the valuation of the pension fund net liability. As we've mentioned a few times and Barry covered, there's material uncertainty which impacts the valuation of the pension fund assets and the authority share of those assets. And there was also the change in value of the pension fund, which the authority became aware of after the submission of the draft accounts, and the accounts were updated for that change. Again, they are the only two findings from our work in relation to that significant risk. I'll just talk through a few other elements of the report. On page 10, we highlight our significant findings arising from the group audit. And this just really confirms that we've reviewed the consolidation of the Keswick Museum, Helena Thompson Museum, Allerdale Investment Partnership and Allerdale Waste Services Limited into the authority's group accounts, and that we were happy that the consolidation had been carried out correctly. Moving on to page 13, we summarise our significant findings in relation to going concern. And on this page, we just highlight that we agree with the accounts being prepared on a going concern basis, and that we were satisfied that a material uncertainty did not exist around going concern. And obviously, we highlight what informed our judgment, which was really the council's financial sustainability and kind of medium-term financial plans and projections on reserves and available cash balances. So on that page of the report, we just really document why we were comfortable that a material uncertainty around going concern did not exist. I'll just talk a little around the going concern, the value for money significant risk areas. So from page 18, we disclose kind of our consideration against each of the significant risks that Gareth discussed in relation to financial sustainability, the waste contract and the stadium. And I'll just very briefly just mention what informed the judgments that led us to reach the view that there should be an unqualified opinion. So with regards to financial sustainability, as we set out on page 18, we're comfortable that overall the council has good financial reporting and monitoring arrangements in place, both for kind of monitoring in year, but also setting budgets and setting medium-term financial plans. We noted that planned recurrent savings were delivered during the 2019-20 financial year. We also do reflect that the council has incurred additional costs in relation to, particularly in relation to the waste contract, which has put additional pressures of around £900,000 on usable reserves in year. And we've also highlight against this significant risk that there is an overall downward trend in the council's usable reserves obviously because of a variety of pressures. And going forward in the medium-term financial plan, there is a budgetary gap, which I know the authority is looking at options to close going forward. So in terms of financial sustainability, overall, we're comfortable that the arrangements that the authority had in place were appropriate, but there are clearly challenges in the future, and we've made recommendations around those issues. Moving on to page 19, we just outline our work against the Workington Community Stadium project. Obviously, one key consideration for us was obviously there was some significant costs incurred in relation to the project during 2018-19. But from the work that your own kind of scrutiny arrangements has done, we were aware that around 55% of these costs will be lost, but the other side of that is 45% of the costs incurred is still relevant to the future project. We obviously looked at the work of the task and finish group and the program management office, looking at the decision making around the stadium project, noting their overall conclusion, but also noting the recommendations that were made around wider stakeholder engagement, ensuring an effective capital project governance framework is in place, and having a capital program manager to advise the project teams going forward. And I think in reviewing those recommendations, we could see that kind of actions were being taken to kind of implement those recommendations. And then also consideration on the stadium project was that there was evidence that the project had been taken forward during the 2019-20 year, and that it was now part of an application for the government's towns funds going forward. So on the stadium, really, we could see that the project had been taken forward during the year. Finally, on the waste contract, as we set out on page 20, we noted that there was, for a time, significant disruption to service delivery during 2019-20. But we also acknowledge the council did take action to address this during the year. And then another key consideration for us was looking at the decision making around future service delivery during 2019-20, looking at options for 2020 onwards and the establishment of Allerdale Waste Services. And overall, we felt that the council was proactive and took proactive action to address the service failures which were happening during the year, and to put arrangements in place to kind of to deliver the service going forward. Again, we looked at the work of the procurement task and finish group and the findings and the recommendations, and we could again see evidence that these were being kind of considered and starting to be addressed by the council during the 2019-20 years. So again, acknowledging that there was a significant cost incurred to the authority during the year because of the kind of shortcomings on the arrangement, and acknowledging that there was disruption to service, but because of the proactive action taken, we were overall satisfied with the arrangements in place in relation to waste. So just the last thing I'll just highlight is on page 22 is that we do make two recommendations in relation to financial sustainability. And with regards to financial sustainability, it's really around the fact that it's obviously we're operating in very uncertain times, and there's considerable uncertainties and assumptions need to be made about the future in financial planning. So I think our recommendation is really around ensuring that there's a sensitivity analysis carried out when carrying out producing these financial plans to really reflect the uncertainties, most of which are associated with COVID, but also around future government funding, so that can inform future kind of financial planning. And then the second recommendation that we make is just around ensuring that the recommendations which have been raised by the Programme Management Office and the Programme Procurement Task and Finish Group in relation to Workington Community Stadium and waste and recycling are addressed. to ensure that the key learnings are embedded into the council's arrangements. So that's all I wanted to say on the detail of the report, but like Gareth said, we're happy to pick up questions on anything which we haven't covered off in our presentation.
Right. Okay. Thank you, Richard. And also thank you, Gareth, for your presentation. Have we any questions of Richard and Gareth? Am I still? Yep.
Councillor Bainbridge, then Councillor Campbell Service Chair.
Yeah, thank you.
Thank you. I would just like to say that when I read the actual report and looked at the value for money, I was quite concerned that you almost gave us a qualified opinion, because in all the years that I've been in audit, and I have been since I started the council 10 years ago, we've never had that. And I know there's lots of explanation in here of what's happened and why, but I think the audit committee needs to know the key things that we need to do to avoid this ever happening again. Thank you.
All right, thank you, Councillor Bainbridge. And I'm sure we all share those same thoughts. Okay. Sorry, Councillor Campbell Savers, please.
Did Richard and Gareth want to say anything in response to Councillor Bainbridge there? Is there any advice for us moving forward as a committee?
Yeah, no, I think everyone's acutely aware of the challenges that you've been through, you know, and I think it's just as we've outlined in the report. It's so important that, you know, you continue to learn the lessons, because we do know from experience elsewhere when sometimes these major procurements go wrong, it can have serious and long-term detrimental impact on authorities. So as I say, it was quite a deliberation for us to get to that conclusion, but I think you, as those charged of governance, can take comfort from the fact that, you know, through your own arrangements and your own scrutiny arrangements internally, you know, you were on this. And I think that was a key deliberation when Richard and I were taking this through the National Consistency Panel. That was a key determinant in this. So I think the lessons from that are, you know, continue to seriously, you know, as an audit committee, as those charged of governance, is you making sure that those actions are delivered, getting assurances from management that those actions are being delivered, and that the lessons are learned going forward.
Chair, could I perhaps come in on that as well?
Oh, certainly, Catherine, yes.
Yeah, it was absolutely just to back that point up. And I think if you look on the two recommendations that have been made by Grant Thornton and the management response, is that we're absolutely committed as a management team to learn the lessons from those two internal reviews. There's a set of recommendations in there that we're absolutely committed to learn the sort of lessons. Some of that's in place at the moment. We've already we're working on looking at the new target operating model for how we work as an organisation, and particularly around the appointment of programme managers and the capital and commercial manager in the programme office, which is key to us. So it's, you know, it's really absolutely committed to learning from those lessons and implement the recommendations of both of those internal review groups. Thank you, Chair.
Right, thank you, Catherine, for that comment. Richard, can I ask a question of, on page 7, you mentioned that note 20 should be updated. Has this actually been done in the previous item?
That is an unadjusted. Barry or Catherine might comment on the rationale for that, but the amount is immaterial.
Yeah. Okay. So as far as you're concerned, you're satisfied with Barry's response to that? Oh, you still require something in writing, I think, don't you?
It's a disclosure point which relates to a disclosure note in the accounts, and because the amount's immaterial, we're satisfied that it hasn't been adjusted in the final. We're comfortable that it hasn't been adjusted in the final version of the accounts.
Okay, right. So if there aren't any more questions, I mean, I'd like to reiterate the same comment.
I think Councillor Campbell-Savers wants to come back in.
Oh, sorry. Yeah, Councillor Campbell-Savers.
I just wanted to check, did Richard say that he thought that there'd been some task and finish groups that looked at the stadium project? That's something if you did say that, that's something that didn't happen. My recollection is the only time that went before scrutiny was I believe there was a call-in after the decision to scrap the project. Are our external auditors under the impression that overview and scrutiny played a bigger role in that?
Yeah, I think I might have just got a word mixed up there. So the wording we've used is on page 19 of our report. So, and we're referencing the Council Programme Management Office carried out post-implementation review of the stadium project. That's what I was referring to. If I did say that when I was presenting, that's just that was a mistake.
Chair, can I carry on with questioning, please?
Yes, certainly, Councillor.
I mean, I've been trying to find a more sophisticated and less political way of asking this question, and I'm struggling. But our external auditors may be aware that there was a bit of conflict in the political side of this council over the decision to scrap the stadium project, and a lot of it relied upon a difference of opinion as to whether there was a lot of risk involved going forward. And in terms of kind of making a decision as to kind of value for money on a project which gets scrapped, it's a difficult thing to do unless you look at the risks going forward and justify not proceeding on the grounds that there was too much risk. Is that something that the auditors consider?
Yes, Chair, I'll respond to that. Yeah, without getting into the political side and the decision making around it, as you can appreciate, our value for money code is very much focused on the arrangements in place during the year. So in terms of informed decision making, sustainable resource deployment, and working with partners. And you could say this is a classic example where it flows across all three of those areas. It is something that, in terms of it is the council's decision as a collective as to where it sets its risk appetite. It's not for us to comment on that, but it is for us to look at the arrangements you had in place, and therefore that is why we've come at it from that angle of, through the committee and the Programme Management Office, in terms of their recommendations. That is where we see, the lessons being learnt from that, which encompasses to a degree the point you're making, that is addressed going forward.
I appreciate the appetite needs to be set by our executive, but did you see evidence that appropriate consideration had been given to the actual identified risk?
It's one that I think it's very difficult for us to answer that. Management may want to come in because it's your arrangements and the views of management have to carry here. We are just looking at it from the arrangements point of view. Clearly, in looking at it, there is evidence of, there are elements to it that needed to be addressed, and hence why there was a change in going forward. And I suppose it is what it is. I suppose we may have come to a different conclusion if the council had proceeded with it as it was originally planned, because that then could have exposed the council, as I outlined earlier, could have exposed the council to more significant liabilities and future liabilities going forward. So it's never an exact science, this, is it? And as I say, I can't comment on the risk appetite. And yes, it's clear that the authority set a more of a risk-taking appetite around this initiative originally, but through the course and passage of time, that has changed, and the project has been rescaled, as we all know, as a result. So I think, unless management want to come in and comment further on that, that's where we were coming at it from, and that's what led us to the conclusions that we've made.
Hi, thank you, Gareth, for that explanation. Councillor Campbell-Savers, are you happy with that, with Gareth's explanation?
Yeah, I mean, all projects are inherently risky. I'm struggling to kind of understand exactly how you can evaluate this. But yeah, no. And for a non-political answer where you avoided it very well, politicians could do well to learn from an answer like that. So thanks very much. Could I ask more questions, Chair, please? Perhaps on
certainly
on the waste contract. I note again, there's a reference to the task and finish group. This is actually in the report. And bear with me a second while I just locate that for myself. It's funny that you've seen that, because unless I'm mistaken, I don't believe we've actually seen the report from our own task and finish group on this yet. So as an audit committee, unless any of the people here have sat on any of those task and finish groups, until you've written some comments about those 9 recommendations, I've not been made aware of these at all, which is, I think it's a bit of a shame actually that I'm reading about them here and that we've not had an opportunity to see them. Am I correct there? Would any of the managers?
Yes. Well, I can answer that question, Councillor. The task and finish group has signed the report off, or the draft report off, in the last week or two, and I understand it will be going forward. I'm not sure it's not going forward to scrutiny tomorrow, actually. But there has been, I mean, the penultimate meeting was some time ago, and so in effect, we've done most of the work certainly by Christmas in terms of our involvement. But yes, the report, for whatever reason, the delay in the report, it has been signed off now, and I think you'll find it on the scrutiny agenda tomorrow. I'm not on scrutiny, but
it just seems a shame that we're looking to obviously form an opinion on this today and sign it off, that it contains reference to work of our own councils that we've not even seen, Chair. And I just think that's a bit of a shame, really. In your report, there is a reference to the looking to make savings. Now, I need to get the timing right here. That it suggests that there are 3 ways that the council are looking to make savings on the waste contract. One of the proposals was charging for green waste. One of them was fortnightly collections for residential waste, and one charging for bin replacements and charging for bin replacements. Now, this is business which has been dealt with by the council. We did a consultation, and we've opted for one of those. Can the management team confirm whether these are still under consideration, or whether this has been put to bed and it's just because of the timing of when this report's been produced?
I can come in and take that one, Chair.
Yes, certainly, Catherine.
No, there's certainly those options are all still on the table. Allerdale Waste Services, as you know, started in April of this year, and as they've been embedded into the business, one of their key challenges was to look and review the operations of the service to see how it could be done differently, more efficiently, and drive better value out for the council. So at the moment, they are considering a number of options around service delivery. Some of those options that you've just discussed there certainly being worked up by the team at the moment and due to go, I think, to the shareholder committee on the 14th of December.
So the reference to charging for bin replacements under consideration, that has been implemented now, hasn't it? That is
no.
All right. I correct myself then. I thought these.
You're correct. It was part of the budget consultation last year and part of the original plans, but then it didn't take place this financial year in terms of the bin replacements.
Okay. So will there be any further consultation with the public on that?
Interestingly, we were just talking about the budget consultation yesterday with the executive, and the budget consultation this year will most likely include some references around waste and delivery of waste services. So yes.
Okay. Chair, can I ask one more question?
You will do, won't you? Yes, certainly.
There's a reference in the report of the waste section, and again, because whilst we're waiting on the output from our task and finish group, but there is a reference here to the fact that we were there was already a contract. I'll read the wording. Actually, the overwhelming bulk of this payment to the contractor, this is a reference to the 0.9 million additional expenditure in 2019-2020. One of the contentious points as to whether, there were, some councillors were making comments in the paper around this, was that there wasn't a proper contract in place. Did the auditor look at the contract arrangements and satisfy itself that this was a mistake?
Sorry, can you tell me what page you're on?
I don't. That's in my notes, Chair. Bear with me 1 second. I'll see if I can find it. Page 20, Chair.
20?
Yes, please.
Right. Yes, yes, certainly. Sorry. Yeah.
Okay. So, as I was saying, one of the areas of contention here was around whether there was a contract in place and whether it was an enforceable contract was in place. Is that something that's been looked at by this audit?
The audit did consider the matter, both in terms of the accounts and there being any potential liabilities or provisions required, and it also considered management representations. I wouldn't want to say anything further on that given the sensitivity around it, unless management want to add anything. But I think it's a very sensitive matter, but you can be assured that from an audit perspective in terms of our statutory responsibilities, both on the accounts and the VFM, we did consider it as part of the audit on both the accounts and the value for money work.
Thanks very much.
Right, and thank you, Gareth, for that response. Okay. So are we ready to proceed with acceptance of the audit findings reports subject to the final modification, well, any final modifications that come about? Could I have a proposal and a seconder for that, for accepting the report?
I propose it.
Second it.
Thank you. Okay, so that's proposed and seconded. And now I think I can just then take this forward. Thank you, Gareth and Richard, for the report. And we can then go back to the previous item, I guess, to make recommendations for that. Oh, sorry. Yes, we perhaps could do that now because item 10 is going forward, I think. Am I right in that item 10 is basically going forward?
No, it's connected.
Yeah, can I suggest that we could take the next item and then we can go back to
yeah, that's
the
more
accounts.
sensible. I've forgotten about the letter of representation. Yeah. Okay.
Barry, are you okay to lead on this? I don't think I've got a copy of it in front of us.
No, I'm happy to say that. Okay, so I'll just introduce this particular item then. I think most members who've been on the committee for some years now will be familiar with the letter of representation. But again, just to by way of background, the requirement for a letter of representation really stems from auditing standards, which essentially requiring the auditor to obtain representations in the form of written evidence, and this normally takes the form of a letter. And they've also got requirements to communicate to those charged with governance information about the representations that have been requested from management. Essentially, as it's in the report, it's just to ensure that those charged with governance are aware of the representation on which the auditor intends to rely in expressing their opinion on the financial statements. You will have picked up from the report. The purpose of the report is essentially twofold. So on the one hand, you will see representations in that letter, which are essentially about us confirming that we've fulfilled our responsibilities as regards preparation of the accounts, and also that we've provided the auditor with all relevant information and access to records during the course of the audit. And the second aspect is specific representations in respect of particular items within the accounts themselves, and generally these are used to support other evidence that the auditor obtained during the course of the audit. And these will often reflect representations which basically just codify management intent around certain aspects of the financial statements. I don't really want to say any more about that, but I'm happy to take any questions. And again, I'm sure Gareth and Richard will field any questions related to those representations as well.
Are there any questions on item 10? Okay, it seems not. Okay, then our requirement is to approve the 1920 letter of representation, and also approve that the S151 officer signs a letter of representation on behalf of the council. And that, I think that's you, Barry, is it? Oh no, it's Catherine. Yes. So can I ask for proposer and seconder to approve those, please?
I propose.
Right.
I'll second that. Thank you.
Right. Thank you, Mary. So that's proposed and seconded. And are we all in favour? Please indicate if there's any anyone not. Yeah. Okay. So we're all in favour that we approve it, and the S151 officer signs it. Okay. So now we can go back, I guess, to the recommendations on item 8. And the recommendations, of course, are that one, we approve the statement of accounts, and that following approval that the chair of the audit committee signs and dates the statement of accounts. And two, that we approve, subject to receipt of the signed audit opinion, publication of the statement of accounts by the statutory deadline of 30th November 30th, 2020. So can we again have a proposer and seconder for that, please?
Propose.
Thank you.
I'll second it.
Right, thank you, Councillor Campbell-Savers. So are we all in favour? Yeah, seem happy. Yes, okay. Right. Well, that looks as if that's the end of the meeting. It's lasted 2 or 3 days, so it's a fairly long meeting. But thank you. I think I have to say there is obviously, to Grant Thornton, Gareth and Richard, there has obviously been a lot of work and a lot of good cooperation to get these accounts out on time. And I know you've been doing it for years, but you know, you've been doing it in a manner that well, in an excellent manner. And I'd like to thank you particularly for your judgment in the value for money situation. Okay.
Chair, I think Chair, sorry about that. A couple of councillors want to come in.
Oh, sorry.
Councillor Campbell-Savers and Councillor King.
Yeah.
Just wanted to say, I know I said it last time, but I just wanted to thank Catherine, Sharon, Paula, Barry and Gareth and Richard for allowing us to delay this meeting again. It just gave us that little bit of extra time. I really appreciate that. So thank you.
No problem.
Okay. And Janet, did you want to come in?
I just wanted to thank all the officers again for all their work, because it must have been absolutely horrendous this year, but they put in an absolutely wonderful effort. So thank you.
Right, and I'd like to add my thanks to that as well. And,
Thank you very
right,
much.
so that sorry, Catherine.
I just said thank you very much.
Okay. Right, well, that looks like it brings us to the end of the meeting. So thank you, everybody, for it's been a long stint. Okay.
Thank you, Chair. Thank you.